what's up, everybody? Paul here with this week's episode of WESPN. And of course, I'm with my main man, Scott. Now, Scott, first things first, Lions.
Ooh, painful.
It's been a long week. It's been a hard week. I know you were at the game. I was at the game. Tough scene there at Ford Field.
It sure was. We had some Washington fans surrounding us, and some moments where we were chirping them, and then that didn't last too long.
I can't stop thinking about it. It's the more I think about it during the week and how it still stings, I'm like, I'm such a loser. Like why is this affecting me so much? But sitting there watching that game and with all the hope and everything this year, it stings, man. It stings. You invest so much time, energy, money, and passion towards it, and for it to all just fall apart right in front of your face.
Well, this was the year, right? We had a monster year last year, almost made it to the Super Bowl. Should have made it to the Super Bowl, arguably. Up, 3 scores heading into the second half?
Last year hurt more for me than this year. And to be a half away, that killed me.
Yeah. But it set the expectations for this year,
Yeah.
kind of Super Bowl or bust. So
Obviously
that's off the table. Give credit to Jaden Daniels and the Washington Commanders.
Respect.
He's a good player. He carved us up.
Yeah, I mean, there's so many points in that game you could talk about. But for me, it comes down to the 5 turnovers. At the end of the day, you can't turn the ball over 5 times and win. Although you did it earlier in the year, turn the ball over 5 times and win. You also had 5 touchdowns out of Goff and lost, right?
Right.
Just a tough scene there at Ford Field, though. I mean, I think I sat in my seat for 20 minutes after the game and just.
Waiting for the crowd to clear out?
No, I couldn't leave. I couldn't leave. It was like the casket being closed, and you just don't want to leave for that last time. Does that make sense?
Yeah, it does.
Same thing, right?
Yeah, it's very, very
same
relatable.
Thing. So I mean, and then where my seats are, it's on the Washington sideline. So all the Washington fans started coming down, and I was just surrounded by all these Washington fans. Trish was looking at me like, "Can we leave?" I'm like, "I'm not ready yet.
I'm grieving."
Yeah. So it was. It's been a long week, but we'll get over it. About a 10-pack of therapy sessions, and 4 or 5 months, I'll be over.
Well, they've got a great team, a great culture, and the future's still pretty bright. So lost Ben Johnson though, so that's not ideal.
And that's okay. We'll lose our defensive coordinator as well, and
he can go for all I care.
Yeah, but we're built for a few years here at least, and we'll see you next year at Ford Field with the raised ticket prices again. Anyways, that's another topic. Pretty cold out there as well.
My goodness. I've got a few rental properties that have some frozen pipes this morning.
Oh.
So, pain. It's just absolutely freezing.
So how do you deal with that? What's the process? You get some frozen pipes. You get a call from the tenant. These properties aren't managed. You're managing it?
I manage these myself. So, get the main water line shut off. Pressure can build up, leading to pipes bursting.
Yeah.
And then you want to get it thawed out, so we got some space heaters running down there. Okay. And then we're going to insulate the lines. The lines aren't insulated.
Yeah.
Outside walls, too cold. So the plumber's taking care of that as well. So we just hope that the pipes don't burst. Right now they're just frozen water in there, So
now this isn't in our topic list here that we want to talk about, but since we're talking about it now, investment properties. When should you manage your own property, and when should you bring in a property manager?
Yeah, it depends on the size. For smaller stuff, it's really hard to find enough cash flow to really justify hiring a manager if you're just starting out. Mm-hmm. For me, my personal rule is once I have enough income for my portfolio where it doesn't really hurt too much to have them all professionally managed, that's when I'm going to make the transition. And we're getting pretty close there. But it took years. I managed it myself. Also great experience as well if you're just starting out. So that's my rule of thumb. Everybody's got their own thoughts, of course, but... Yeah, if you're just starting out, I'd self-manage for a while.
Now, when you have a portfolio, do you look at the portfolio as a whole?
I do, yeah.
Okay, so you don't look at every individual investment as a separate business. You're looking at the whole portfolio as one and trying to get to a point where it's profitable enough to bring in a property manager for some or all.
Yeah, I would probably just do the whole thing. But, I look at it as a whole. Some properties are cash flow negative now, right? Mm-hmm. Rates went up 500%.
Yeah.
But my whole portfolio is still cash flow positive. So that's how I view it.
Do you use a system for your portfolio? Is there like a app or a tracking system for that?
There are some options. I've looked into them, but because I plan on transitioning out of management, I'm not going to invest in anything like that. There's some stuff out there. Most of it's geared towards 50 to 100 units or professional property managers.
Yep.
So I haven't pulled the trigger on anything like that, but
Nice. But there are those options out there.
definitely.
Good. Now, while the lines are out, feels like the spring market's definitely in.
What a transition.
Right?
Wow.
I mean, that's a great transition
Wow.
right there. As expected, I mean, last week was the first week where I really felt the buyers are super active.
Same.
Right.
100% the same.
Showings are up across the board. Offers, I mean, we're tracking a lot of properties out there. A lot of properties are in multiple offers, and I'm not talking 2-3 offers. I'm talking Dolphin with, what was that, 20 something offers. A couple other properties.
Corby with
in the high
20
teens.
plus. Yeah. So
Corby with 20 plus. Again, it's always listing specific, but the advice that we had before, and a lot of noise out there over this advice, was, listen, hold off. We tend to see the market have an uptick in January, and that should continue, not just a small uptick like we see in October for the month, but January should uptick till May. Right?
Absolutely.
And it's following that trend, and again, it's a very predictable market. That's what I felt last week, 100%.
Yeah, so we had at least 2 properties I'm aware of with 20 plus offers on them. Very unique, right? We're not saying this is going to be the case for every situation, but in my opinion, if you tried that strategy in January, from January 1st to the 14th or in December, it wouldn't have generated that many offers.
Yeah.
I almost guarantee it. Maybe only a few, even though they were underlisted. So it's happening as we predicted. It's happened every year for the past 3 years. This year's no different. The only difference is this year versus the last ones is we have the rate cuts that have happened and are projected to continue coming. So a little bit of fuel to the fire there.
Yep. It's nice to, as a realtor, it's nice to get all these showing requests, because keep in mind, like, if we list a property and we have no showings, the biggest thing, obviously, with it's not going to sell, but we have no feedback, right? And
Great
if
point,
I have
yeah.
no feedback, I can't re-strategize or tell my sellers what's going on with the marketplace and how the marketplace is feeling about their property.
Yeah, great point.
If I have 30 showings and I have all the feedback and I get no offers, well, then I can look them in the eye and say, well, your property's not worth this, right? If I have 30 showings and I get 4, 5, 6 offers, well, the conversation is different. This is what your property's going to be worth today, and then we'll make a decision of whether or not we want to sell.
Yeah, and that's a great point. The market's telling you, based off the number of showings and the offers that have come in, what your house is worth. But if you're not getting the showings, you don't know. Is it seasonality? Are people just on the sidelines right now because people aren't coming to see this property? It looks great. We've done everything that we normally do to get it marketed, but nobody's coming. No feedback, hard to tell the client what's going on. That's what was happening in January, early January and December, even November last year.
I agree.
A lot of and the conversation is, listen guys, like the seasonality is playing a factor here. We can't make any decisions based off of this, and then you're usually trying to get them to revisit it in our spring market, which is starting to pick up now and should trend higher into May, maybe June, and then start to level off as
the inventory rises.
So
We're active listings in, we track Tecumseh to LaSalle and everything in between. We're at in the low 5s right now, right? So again, as promised, the inventory is coming down, but the buyers are out there. So it's if you're thinking about listing right now, it's a good time to list.
Mm-hmm.
Okay, I'm not gonna say there's no better time. I'm not gonna to throw that out there, but it's a fantastic time to list. Even the stuff that I did list in November, December that's still up is either showings have gone up on those as well, and I'm getting offers on them. So I mean, welcome to the spring market. Everybody always thinks it's when the buds start coming on the trees and all of that. Hello, we're in it. Spring market. It's January 22nd when we're filming this. As expected, great time to list. Okay, next. Trends. Okay, so 2024 compared to 2023. The numbers are in. I know how much our viewers love stats. I mean, they can't get enough of them. They just like yum 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 yum. They just eat them up. If you're on our mailing list, you get these emails. But we'll break these down really, really very simple for you because we have 2024 compared to 2023. The biggest number here is listings are up almost 12%. So it's the number of listings that come to market. 2024, 11,548. 2023, 10,316. That's a big jump. So that, what does that mean in layman's terms? High inventory. Sales, though, only up 3.34%. That's the number of units that have sold. So again, a high inventory market, things are selling. You got to stand out, though. You got to stand out with location, condition, pricing. Okay, you have to stand out. And then the average sale price up about just under 4% at 3.91.
And that's year over year, correct? 2023
year over year,
2024
over 2023.
Yeah, and that's a big enough sample size to draw some conclusions from there. And the big one for me is obviously the 3.9% increase. That's probably like around average. That's normal. That's a normal, healthy market. And it shows you the difference of when interest rates start coming down, sentiment starts to improve, even though affordability hasn't improved yet because of the stress test, and the pre-approval amounts are still muted. The sentiment really changes when rates start coming down, and you're getting lower variable rates as well.
Yeah,
so we're seeing that reflected in pricing.
Last year just felt like a healthy market, right? And as it should be. When the inventory's out there, which inventory should always be out there, you should always have choice, right? So when you have a choice, you're going to pick the one that looks the best, right?
Suits your needs.
And then you're going to say, I like this one the best. Does the price make sense? And if the price makes sense as well, it will sell, right? So I like when the buyers have choice. We've been in a market where inventory was extremely low, and as fun as that was, and when that went away, you miss it. This is a healthy market like this is good because we work on both sides of the transaction. And it's an enjoyable market to work in, I'll tell you that much.
Yep, couldn't agree more. Good for the economy, good for everybody involved, in my opinion.
Now, Royal LePage is saying they're expecting a moderate increase in 2025. This is Canada-wise, driven by high demand and limited inventory. And Windsor is expected to see growth, particularly in the family-friendly neighborhoods. And we'll probably, our expected growth, I think, is somewhere around that 5 to 6% mark, which again, very healthy. I think when we run numbers, we, with inflation and everything, we account for about a 5% increase per year, which is on average. Would that be true?
Yeah, it sounds about right. I, as an investor, I always run my numbers at the inflation rate, the core inflation rate, just to be safe. But I think that the housing prices in Canada typically go up a little bit higher than inflation. So it sounds about right in what I would use. And Windsor's still high demand. Yeah. A lot of catalysts here, and the cheapest city in Ontario. It's a lot of catalysts here. A lot of people still moving here because you can't afford it anywhere else. So
even that increase from 2024 to 2023 at 3 point whatever percent it was, I'm ecstatic about that. There's other markets where they're going the other way, right? So Windsor fundamentals are remaining strong, and it's nice. It's a very enjoyable market to work in.
Yep, fair and balanced. But yeah, so on that note, from a more macro perspective, assuming you were done there with the stats, okay. From a macro perspective, we do have the Bank of Canada announcement on January 29th. Correct. The Canadian inflation report was just released yesterday. Some good news and some bad news, I guess, depending on your perspective. The good news is that inflation is down. They had it at 1.8%. They also, some people are arguing that if you took out housing costs, mortgage interest payments, and rent increases, that would actually be 1.3%. And some people are saying, well, that's actually deflationary. Like the economy is really getting into dangerous territory, right? Right. Because you can have too high inflation, you could have too low inflation, where
What does too low inflation do to an economy?
Well, it's basically saying that things are stagnant, and it's a reflection of unemployment rising and low business activity and falling wages, and people just don't have money to spend. So it's really a combination of factors. And because of this, I'm looking at it as this is clear signs that we're going to continue to see rate cuts here heading forward, starting on January 29th, where most people anticipate a quarter point. Yep. I think the half points are probably done unless things get really bad, but we might see like a quarter. The Bank of Canada's neutral rate target is 2.25 to 3.25. That's where the rates aren't inhibiting the economic growth, but they're not too low where we see what happened in 2021.
Right.
And overspending, asset inflation, all that stuff. We're at 3.25. Obviously, it's not low enough because inflation wouldn't be dropping so quickly. So there's some debates there, but we know the impact that lower interest rates have on the real estate market, or any assets for that matter. We would anticipate at least a nice floor for real estate prices here.
Yeah, going through a full cycle of, starting my career in 2007 and going through that was a long cycle. You learn so much, and I will say, when I first started in real estate, I didn't know what an interest rate was, right? I just thought everything was cheap. And the interest rates, at one point we wanted them to get down to 5 and 09, 10 or whatever it was, and that was great. So interest rates, as my knowledge goes up, interest rates are such a driver to the real estate market, the biggest driver, no doubt about it.
Yeah, if you had to ask me, what do you think is more important, the state of the economy or interest rates? I would probably say interest rates overall, although they're obviously very important, both of them. But it really is. I mean, it's the cost of money, and it's your borrowing power. It's all impacted by interest rates. It's really the Bank of Canada or the U.S. Federal Reserve. It's kind of their only tool to channel economic growth. And the thing is, the reason I say also that it's more important than the economy is because the low interest rates lead to economic stimulation. If I'm a business, now I can go borrow money at cheaper rates, expand, hire, invest in new equipment, invest in new plants and opportunities. We saw that come to a halt here because you raise rates 500%. Businesses go on pause, builders stop building, all that stuff, right? Yeah. So some interesting stuff there. And then if we couple that from a macro perspective, obviously we were talking about this the other day with the potential Trump tariffs.
Yeah.
There's quite a bit of fear out there.
Yeah, tons of noise out there, tons of fear. I mean, when he's throwing the numbers out there, he's got the deadline for it. Negotiation tactic, or is this a large?
Well,
concern?
I heard somebody talking the other day on a podcast. They said you always take Trump seriously, but you don't take him literally. So he's serious about tariffs. Is he serious about 25% blanket tariffs across all of Canada? I'm going to argue probably not, because it would hurt a lot of U.S. businesses, and he's a businessman, and you don't want Ford in the U.S. calling and saying, "Hey, you're really messing up our flow here. We get our steel from or aluminum from this plant in Canada. This changes everything. We can't even function." So I think he's smart enough to recognize that. And if I was him and I'm a good negotiator, I'm coming in hot. Just like if I'm negotiating a real estate deal, if I'm trying to get a deal, I'm going to come in low and meet somewhere in the middle.
Yep.
So that's my perspective. But I do anticipate something, right?
Yeah.
Now, I saw the Canadian government came out the other day and basically said that if these tariffs do come, they're going to be there to support Canadians economically. And we might see something like the COVID years, where they were giving money out to people to deal with the shock, the economic shock, right? To keep things from collapsing. Now, the one thing I've learned across all governments around the world is when crisis strikes an economy and really everything's at risk, including banks and everything else, they come in with bailouts. And if they don't, the whole system breaks.
Right.
So
and they don't want that.
Exactly. They don't want it, and they can't. They would lose all credibility. They would get voted out of power, and people would be rioting in the streets, right? I went to the bank, and CIBC shut down because they didn't have enough liquidity to give me $500. People are going to be taken to the streets. So it always, people always kind of take things typically too far with the rumors, and usually it settles somewhere in the middle. Yeah. I'm anticipating that's the case here, but of course no one really knows.
It's top of mind for many.
My regular clients that are not really too political or too involved in the economy are bringing it up right now on some calls, and there is some fear out there, and I try to check it a bit, but it's an unknown variable, and it creates uncertainty.
Yeah. So many external factors that we can't control, that actually control and affect our day-to-day lives, right? Like whether it's politics, war, outbreaks, stuff like that. So I mean, I stopped trying to control what I can't control a long time ago, and that's kind of where my head's at. Yeah,
the macro is crazy. It's all over the place. But long term, we always say it's up and to the right? Real estate, asset prices, the economy, the S&P 500. These short periods of time and volatility are usually opportunities to take advantage of, although they seem really scary while you're in them.
Right. Good. Love it. Love it. Good stuff there. Hope you guys enjoyed this episode of WESPN. We'll catch you in a couple weeks. And if you ever have any questions or you need any advice or you want to talk Lions, you know who to reach out to. Have a great day.
Paul's therapist.
That's it. Thanks, Scott.